Welcome back to the ICT or SMC Beginners course. Today we're going over everybody's favorite ICT term and concept, and it's probably one of the most misunderstood or misutilized concepts out there, and that's going to be the ICT order block. Now we're going to go over how to identify these things, how to actually utilize them, where to take entries, and ultimately how you can start recognizing these and building them into your trading plan and model so you can start taking higher risk to reward trades with low drawdown. Okay, so whether this is your first time to order blocks, or you've learned about it from somebody else, or you've heard some theories behind order blocks, let's get into how I would actually define order blocks, or specifically how you've probably heard it defined before. So what that's going to be is the last or lowest down close candle before an up move. So if we take a look at this example here, an order block, a bullish order block I might add, is going to be the last down close candle. So if you can see here, my candles that close down, or my bearish candles, are going to be black as per usual, and the green ones are bullish. So when price should bounce off of this candle because it's the last down close candle before an up move. And more specifically, what we want to be focusing on is, although this entire candle here is technically the order block, so this entire candle here is the order block, what we want to be focused on for the most part is going to be the opening price. Okay, so on a down close candle, that's the top of the body here, and I've got this marked out as plus OB for bullish or positive order block. And as you can see here in this example, price could have been entered here, or price could have been entered here on this bullish order block, expecting higher prices. Now, it's not quite that simple, so let's actually get into the nitty-gritty definition-based rules that allow or qualify an order block to be traded off of and actually respected. Because for the most part, this is what's neglected and this is what's missed when it comes to identifying, defining, and qualifying order blocks. Okay, so now let's go ahead and get into qualifying a bullish order block and the actual specific things that you need in order to identify and actually pick these right order blocks, because it's not just every down close candle that's going to support price. So first things first here, what we're going to need is we're going to need to have a reason for price to retrace and or reverse from this area. So what I've done here is I've left this black line here, and we can think of this ideally as potentially a liquidity sweep, but this could also be a higher time frame fair value gap, another order block, a breaker block, an inverse gap, anything of the nature. However, the important thing here is that you have to have narrative behind the trade. If you can't make an argument and a solid reason for price to actually bounce here, then there's no reason to even be looking at order blocks, because we're still bearish and price should be rejecting bearish order blocks, not respecting bullish ones. So as long as you can make the argument that price should be retracing or reversing off of an area here, let's call this a liquidity pool, now you can start to look for order blocks. So now that we've swept liquidity here, we can anticipate that price might want to go higher and start to form bullish order blocks. So we now have narrative. We're then going to need for price to trade above the high of the last or lowest down close candle. So if we're expecting this to potentially be an order block here, we're going to need price to get above this wick here. That's the high of this down close candle, and until we get above this high, there's no reason to even qualify or think about order blocks in the bullish direction or to the long side. So we're first going to need price to trade above this high, or at the same time, we're also going to need price to close above the opening price of the last or lowest down close candle. So if we take a look at this candle here, this green candle, you can see that price has traded above the high of the last or lowest down close candle, right? So above this candle's wick here, price did trade above that. Can we qualify this as an order block now? In my opinion, the answer is no. And why is that? Because we need price to close above the opening price of the last or lowest down close candle. So we're not even going to be talking about we need price to close above this high. We need price to close above the body of this candle, or the opening price of this candle. So if we place another candle here, we can see that this candle not only has already traded above this high, but we also close above the opening price of this down close candle right here. Therefore, we can now qualify this candle as an order block. Now, we're not going to wait for price to come all the way back up here and then retest that, because that's a great way to get wrecked. What we're going to be doing is we're going to be looking for entries specifically off of this candle as soon as this order block is created, because there's narrative and our other two qualifying factors have been met. So the very next candle, you can see it tags into this order block. This one would as well. And you could have taken a long position looking to target higher prices in the form of other liquidity pools up here, fair value gaps up here, or really any other target. But essentially, this is what you're going to be looking for the most part. Okay, so now that you kind of have an understanding of what bullish order blocks look like, let's take a look at this second example here. And the reason why we want to look at this example here is because it's not always just one candle. Okay, so you'll see lots of people online talk about it being just this last down close candle here. And although in this example it might look like that's what price is actually reacting to, I would tell you that the order block is actually the series of down close candles. So if you have consecutive down close candles in this example here, you're going to qualify both of these candles as the order block, and you can see the bodies are actually respecting the order block up here. But not only that, price is also respecting the mean threshold of this order block. Now, what does that actually mean, and what is the mean threshold? And essentially, to keep it simple, it is 50% or the halfway point from the opening price to the closing price of the series of these down close candles. Now, if price was to only have one candle here like this, then you would be qualifying this as the order block, and the mean threshold would be 50% from the closing price here to the opening price of the down close candle here. But because we have two candles in this example, we're going to take the opening price from this high here, and we're also going to take the mean threshold, meaning the 50% level, from the opening price of the highest down close candle and the closing price of the lowest down close candle, and this becomes your mean threshold. And although it may look like price is reacting to this level here, it's actually reacting to the mean threshold of this order block. Now, what's so important about the mean threshold? And to keep it simple, mean threshold is going to be your early indication as to whether or not an order block is failing or being respected. So this is also going to be a sensitive level, just like the opening price of the order block is going to be. But essentially, if you see price close below the mean threshold at any point in time, this is your early indication that the order block is failing. And we'll get into that a little bit more when it comes to stop loss placement, which will be another video. But essentially, what you want to know is this is a sensitive level, and ideally you want to have both of these levels on your chart if you are trading an order block. However, the most important level is going to be this opening price here. So now that you understand that you want to use the series of down close candles, let's go over why that actually is. And the reason is because this will essentially, on a higher time frame, turn into one candle like this, and therefore this is going to become your order block on a higher time frame, which is why it holds more value. On a lower time frame, it may look like this, but on a higher time frame, it's going to be one candle, and that one candle is going to make up your order block. Now, at the beginning of this video, you saw a live execution of an order block trade that I took earlier in this week, and what we're going to do now is hop into the charts and go over what I saw in order to qualify that order block and why I actually took that trade. Now, for those of you in my mentorship, you know there's a couple other things that we're not going to cover in this exact video here because this is a beginner's course and not quite as extensive as what we cover in our live education sessions. But essentially, this order block does qualify all these steps that we talked about earlier in this video, and we're going to show you that right now. Okay, so as we take a look at the chart here, we have our first example. And as we can see here, we have the first thing that I want to point out here is we are looking at this high over here right now. We're not entirely sure as to whether or not price is going to reach up here, but this is generally where we want to see price go. We're going to continue to follow this trend, and we're actually delivering out of a higher time frame fair value gap here as well. So if you take a look on the 15-minute time frame here, we have this fair value gap right here where price is starting to bounce out of, and that continues to tell us that we're probably likely to see higher prices, especially after sweeping this internal low here and continuing to move higher. Now, the next thing that I want to point out here is we're building the narrative in the case that we think price can go higher, but what else do we need in order to qualify this as a high probability order block or an order block in general? And that's going to be we need a reason for this candlestick here to actually act as support. So the first thing here that we're looking at is we have rebalanced this fair value gap, which means that if price can get above this high here, right, and close above the opening price of this down close candle, this can be used as support and used as an order block, expecting higher prices here. So as we play this out, you can see we get above this candle. Perfect. So step one was we got above this candle's high. Step two was that we closed above the opening price here. So this can now be an order block, and essentially you can prepare to take an entry as soon as price taps into this. Stop loss, for the sake of the video, we're going to put it below the low, but that's not really how I would have used that. I would have had a 15 handle stop loss, and we'll get into that in another video. But essentially here we're looking at price taps into this order block here and pushes up. I don't believe that's where I got my entry. I think I got it on the retest here. Yeah, so I would have waited for some more displacement up here. And now we've made engineered highs here in the form of these relative equal highs. So now I'm really liking this order block to potentially offer a long position. We have narrative, we have a draw on liquidity as these relative equal highs. We have a bullish order block here, and we have displacement. So I'm looking to take an entry off of this order block here. Price comes down, tags me in right here. A really nice close tells me I'm probably on side of this market move here. We also have this tiny little fair value gap inside of the order block here that I'll point out, but that doesn't play a big role in this example or for my trade analysis at the time. As we can see, price continues to accumulate orders inside of this order block here, so we're giving smart money a lot of opportunity to accumulate long positions in here. Price eventually pushes up here and takes out this high in the form of this engineered liquidity up here, and that's going to be the area that we look to take profits. Now, I also use standard deviations to get a little bit higher in my profit target. I'm not going to go over that in this video, but essentially this is what the first trade looked like, and this is how we could have qualified this order block. We have narrative, we have a drawn liquidity, we have a down close candle that is rebalanced a fair value gap, so there's narrative behind this candle to act as support now. Right, we're expecting price to go higher off of this fair value gap, and when it does, we can expect this price or this candle to hold us up. If we want to draw the mean threshold here, we can do that as well. And as you can see, all the candlesticks stay above this mean threshold. There's no closing price below this mean threshold, so the order block is still valid, and we can see price delivers to the higher engineered liquidity up here before ultimately making a couple new highs and then pushing back down. Okay, so now that we've swept out this buy side liquidity here and we've actually shifted structure to the bearish side below this low here, so this is going to be your market structure shift. If that's confusing for you, I have a video on that already, which should clear this up as to why this is your market structure shift point. But essentially, price continues to go lower. We're breaking structure to the downside here after shifting structure and sweeping liquidity, so we should be bearish in this example. I'm going through time frames here, and I guess this candlestick kind of gives it away, but there's this 2-minute fair value gap right here. Okay, so what does price do? We're looking for price to redeliver into this 2-minute fair value gap, and we're looking for lower prices here because we've shifted structure after our liquidity sweep, and we're probably looking at these relative equal lows right here. Right, so the first thing that I can see is we have engineered liquidity in the form of these relative equal lows here, so that's a nice place for price to target, and potentially even into these lows and this low here as well. So I see price institutional order flow entry drill above, or sorry, into this 2-minute fair value gap here. So if you take a look here, you can see we just tap into the 2-minute fair value gap before starting our descent down. And what does that do? Just like before, we now have narrative. So we're expecting lower prices here. We've seen price reject an area where we expect price to reject, and that's going to be in the form of this 2-minute fair value gap here. We've seen price trade below the low of this candle, and we've seen price close below the opening price of this candle. So this becomes your order block, and this here from opening price to closing price becomes your mean threshold. Now, what do? You absolutely at this point can take your entry right here. Stop loss can go at 15 handles or above the order block high. You're looking for these relative equal lows here and potentially lower. And essentially what I do though is I put my entry at the mean threshold here, and that's just to give me a better risk to reward and lower my risk because I have a winning trade. I don't want to give back too much. If I miss this trade opportunity, so be it. I just don't want to take a large loss if I'm going to take one. So this allows me to increase my risk to reward and keep my stop loss size relatively small here. So I'm totally okay with missing the trade, but I'm taking a greedier entry trying to minimize my potential loss while giving me the best potential reward. But in doing so, I have a less probable chance of getting tagged into this trade. If I put my entry here, there's a high probability chance that I get tagged into this order block. But with my entry up here, it's very possible that price can come up here, just tag the order block, and then go down without tagging me into the trade. Now, I'm okay with that. If that's not something you think you're able to handle, always be taking the opening price here. And more times than not, this is what I'm looking at, and I'm not looking to enter off the mean threshold. But for the sake of the video and education purposes, I did take the mean threshold entry here. As you can see, just like I mentioned, price comes up into the opening price here, but doesn't come to the mean threshold. We're still going to see if we get tagged in. Price continues to reject, and at this point, I'm pretty much expecting that I've missed the trade, and we're going to end up going lower. But with this candle here, price revisits the high here, actually tags me into the trade at mean threshold right here, and that ultimately sells off down to my target within 1 minute. I've made my 4.5 risk to reward and my 25 handles or 24 handles on NQ here. But the main point that I want to focus on right here is that in order to take this trade, we needed 3 things. That was narrative in the form of this 2-minute fair value gap showing us that we're rejecting this. We have a close below the opening price, and we have price trading through the low of this down close or this up close candle here, meaning this is a bearish order block. So when price trades into this order block, and I'll remind you that technically it is this entire candle here that is the order block. When price trades up into this order block, we can expect price to be rejected. And once again, where can we expect price to run towards? Well, just like up here where we had relative equal highs here and engineered liquidity, price runs towards these engineered equal lows, but also the engineered liquidity that was formed with this low right here. Okay, so we faked this out as a support area or a supply area before ultimately, or demand area, I should say, sorry, before ultimately coming down and taking out the liquidity that was provided by stop losses and breakout traders looking to short this. Now, ultimately, we continue lower here. I was not in that trade all the way down here. I was out at these lows because that was my main target, and that was more than enough for me to be happy with the trade. And it was a really fast, really efficient, and really effective way to get involved in this trade. Now, if you had multiple contracts or you had a strong bias for lower prices, ultimately you could have ran this out lower. But for me, I was only looking to take it off at these relative equal lows. So that's what I did, and that was my successful trade. Now, I hope you guys did find that insightful and that order blocks are starting to make some sense here. We will go into a little bit more depth when it comes to target practice and stop loss placement. But until then, if you do have any questions, make sure to let me know in the comment section down below, and I will do my absolute best to answer those. And until next time.